What's up, everybody? Welcome back to another episode of Fill Your Cup. I'm your host, Calvin.
And I'm your other host, David.
And today we're going to talk about part 2 of our first-time home buyer's guide, more specifically, conventional versus FHA loans. Let's get to it.
All right. So on our last video, we kind of gave a little breakdown of what an FHA loan and a conventional loan is. But this here, we're just kind of revisiting that just to refresh your memory, because I'm pretty sure you might have forgot about it. So FHA loans, they have a minimum down payment of 3.5% for borrowers with a credit score of 580 or higher. Conventional, they allow a 3% minimum down payment, but it is reserved for borrower with like a credit score of 600. So the higher credit score, the lower you can put down, basically. Also for FHA loans, are easier to qualify with a minimum credit score of 580 to be eligible for a 3.5% down payment. If your credit score is around 500 to 580, you may qualify for FHA loan, but you have to put down like 10%. And for conventional loan, typically it requires a 620 or higher. So the lower your credit score, it usually comes out to a higher interest rate for a conventional loan.
All right, debt to income ratio. So it's one of the big factors that lenders look in terms of giving you their money. It's the percentage of your monthly pre-tax income that you spend paying your debt, such as mortgage, student loans, car loans, child support, credit card bills. Basically, the higher your debt to income ratio or your DTI, the more likely you're going to struggle with paying your bills. So try to keep that ratio low if you're trying to impress your lender and hopefully get a good rate. For FHA loans, the DTI must be 50% or less to qualify for an FHA loan. For conventional loans, they allow the DTI ratios up to 50%. In some cases too, even though lenders allow DTI ratios to be high, approval is more likely for the mortgage borrowers with DTIs of 43% or less.
The mortgage insurance. Mortgage insurance basically protects the lender in case you guys default. I'm sure you guys won't, but they don't really trust you like I do. So for conventional loans, it requires borrower to pay for a mortgage if the down payment is less than 20%. An FHA loan is required regardless of how much you put down, because that's just one of the requirements of the loan. So premium cost. So FHA loan, the premium cost is the same no matter what your credit score is. For conventional loans, the lower your credit score, the higher your FHA mortgage insurance will be. And then if you have it higher than 720, you probably have a really low premium cost. For mortgage insurance, the FHA loan insurance premium lasts for the life of the loan, because it's just a requirement baked into the loan. If you make a down payment less than 10%, you can get rid of the FHA loan by refinancing. So for conventional loans, insurance is automatically canceled once your equity reach 78%, or if you put at least a 20% down payment on your purchase. Loan limits. So both conventional and FHA loan have a limit of how much you can borrow, and the limit is dictated by where you live, basically. If you're looking for a home in a low cost area, the limit for FHA loan is like 350K ish. If you're looking like an expensive area, it's around 820K ish. Conventional loans they are not backed by the government. So the limit currently is around 550 for most conventional loans. Anything that goes higher, the lender can work with you, and those are called jumbo loans. So property standards. The the property for FHA loans is kind of it's a little restrictive. They kind of they kind of dictate where you can apply an FHA loan. And for FHA loans, there are a lot of kind of like safety requirement. Like you have to meet their construction criteria. You have to meet their local code. So FHA loan there's a lot more requirement when it comes to what kind of homes you can buy with it. But and also FHA loan you can only use it for primary residence. You can't use it for like a vacation home or an investment property. To buy those properties, you have to use a conventional loan because FHA loans they do not apply.
All right. So let's say you already have a mortgage, you already have an FHA mortgage, and you're thinking about refinancing because the rates are really attractive right now. So basically, the FHA Streamline refinance is a unique program available for homeowners with a current FHA loan. So benefits of this is, you could refinance quickly with less paperwork. But there are 4 steps that you need in order to kind of qualify for this refinance. Is first one, verify that you have an FHA loan. That's pretty simple. Your monthly mortgage payment should verify that for you. Number 2, check your mortgage payment history and credit score. Making sure there's no late payments to your mortgage or your credit card, things like that. Number 3, pass a benefits test. Make sure you are lowering your rate at least half a percentage, to qualify for the refinance. And the 4th one is have enough cash to close. Verify you have enough money in your bank to cover for the FHA closing costs for the refinance. So again, for the benefits of the FHA Streamline program is, you won't need to provide any documents, your employment's non-verified, your debt, it won't be considered, you won't need an appraisal, you'll be paying a lower closing cost compared to the other or competitors. You'll be providing less documentation, so hence the word streamline. And lastly, you could use it for your primary residence, vacation home, or rental property.
So summary, conventional loans require a higher credit score, allow smaller down payments. You have more choice of property that you want to purchase, and the only requires a PMI if you put down less than 20% down payment.
Then FHA loans, you could, get approved with a lower credit score, but they require higher down payments, stricter standards. And FHA mortgage insurance is mandatory regardless of down payment amount and can't be canceled unless you refinance into a conventional loan. So you have to get the insurance. So, above all, hopefully, this video gives you a good indication of what route to kind of go into. I think we agree that for first-time home buyers, FHA loans are a little bit more enticing. Don't you agree, or?
I think it's more flexible. I think it depends on your current situation. I mean, if you have the money to go the conventional loan route, then might as well. Just put down 20% and don't have to worry about the PMI. And if everything is hunky dory, you have a good credit score. Basically, it's a credit score. You have a good credit score, you can put down 20%. I go the conventional route. But if you have a little worse credit score and you can't really put down the full 20%, then I would go for the FHA loan to get your dream home. So with that, thanks for watching. Please like, comment, and subscribe, and catch us in the next one. Peace.
Peace.